Welcome to the TrustBridge Capital Market and Economic Observations Call. I'm your host, Eric Jefferson. I think we are officially past the cutoff where it's acceptable to wish folks a Happy New Year. That being said, for anybody able to take last week off, let me officially welcome you into 2025. A lot to discuss today. We're going to recap some of the key themes from the year prior, as well touch on a few of the things that we are most closely monitoring as we get into the new year. Before we begin, though, a few quick words from our legal team. With that, we can begin. Obviously, another banner year for stocks, once again, led by the Magnificent Seven, a collection of mega cap technology companies that have continued to drive the market. They propelled the S&P 500 to a second back-to-back year of 25% plus gains. When we think about the bond market, unfortunately, not the same story. Very volatile year, particularly as the Federal Reserve began cutting interest rates. Obviously, lower rates are good for bond prices. Unfortunately, bond investors did not receive as many rate cuts as they were initially hoping for. Again, that resulted in some very volatile swings, both up and down, ultimately with the bond market ending the year virtually flat. What led to fewer than expected rate cuts? Well, first and foremost, had a fairly healthy labor market. Unemployment, although that has ticked up, still remains below 4.5%. The other side of the equation, inflation has certainly continued to moderate. That pace of moderation, though, has slowed. Have some very stubborn areas, particularly in the housing and service sectors, that have kept inflation from reaching those long-term targets, suggesting more work still to be done. As a result, you take the two of those factors, the Fed ultimately able to deliver 3 interest rate cuts totaling a full percentage point. Again, not the 6 that the market had initially priced in, which seemed lofty, but nonetheless not obviously able to come to fruition. On the economic front, GDP will likely finish the year at 2.5%. I won't get that official data until later in the month. That being said, growth still remains fairly encouraged. Some of the backdrops there, we had a healthy consumer, one that also benefited from a rising wealth effect or increased portfolio and real estate asset values that allowed consumers the confidence to go out, continue to spend. When we look to 2025, anticipate the economy to continue expanding. Granted, that pace will likely moderate. Wouldn't be surprised if that tracks back to the long-term average, closer to 2% as opposed to the 2.5% that we achieved the year prior. All in all, though, we think about the macro environment, likely still conducive to higher prices for risk assets. That being said, I don't think I'm going out on much of a limb here, where I say it's unlikely the S&P will notch a third year of 20+% returns. All in all, when we think about earnings expectations, those are still very lofty. We think about valuations, those are elevated, approaching historic highs. Neither of those factors are necessarily bad for stocks in and of themselves. That being said, when put together, they do create a more challenging environment, one that stocks can certainly appreciate in, but in the same vein, makes stocks certainly more susceptible to a pullback if a catalyst were to emerge. Obviously, those are all trends we will continue to watch very closely. As we shift our focus down to DC, new administration, only a few weeks away from taking control. Obviously, there's been a lot of talk about deregulation, continued tax cuts, tariffs, and immigration. Interestingly enough, all of these are competing forces here. Some good for the economy, some not as much. At the end of the day, it all depends to what magnitude they ultimately play out to be. Certainly, that's something there's been a lot of discussion, a lot of thought and speculation as to what these policies will look like. Truth is, nobody actually knows until new administration is in place. That's something likely will take longer than expected to truly have an understanding what that tax policy will look like, and then from there, how do we begin to understand what impact that will have for the earnings potential, not only for the Magnificent Seven, but for the other 493 names in the S&P 500. That's all for this week. As always, I want to thank you for taking the time to join us, and please encourage you to submit any questions you have. Look forward to catching up soon. Take care.